On October 7, 2025, Prime Minister Mark Carney will meet U.S. President Donald Trump in Washington. The discussions will focus on tariffs, trade, and the review of the USMCA trade agreement. For Canada, this meeting comes at a moment of economic weakness and rising uncertainty. The United States remains Canada's largest trading partner, accounting for roughly 75% of Canadian exports. In September, the U.S. administration announced a 10% tariff on Canadian wood products and signaled possible additional duties on furniture and metals. In response, Ottawa removed most of its previous 25% retaliatory tariffs on U.S. goods. Steel, aluminum, and automotive imports remain protected, but everything else was rolled back on September 1st. That move reflects the limits of Canada's leverage. About 85% of trade with the U.S. already flows tariff-free under the USMCA framework. Carney's strategy is not to launch a new deal, but to use the built-in USMCA review process. That means adjusting existing terms rather than starting over a practical approach, but one that leaves little room for major concessions or new protections. Canada enters these talks with clear signs of slowdown. The latest S&P Global Services PMI for September 2025 came in at 46.3, down from 48.6 in August. Any reading below 50 signals contraction. The employment sub-index dropped to 48.9, marking the first decline in service sector jobs since April. The backlog of work index fell sharply to 42.9, the lowest level since June 2020. That's the 10th straight month Canada's services sector has been in contraction, indicating weaker demand, less business activity, and mounting cost pressure for employers. The broader labor market reflects the same pattern. In August 2025, the economy lost 500 jobs, mostly from the services sector, especially professional services, transportation, and warehousing. The unemployment rate rose to 7.1%, up from 6.9% in July. That came on top of a 4,800 job decline in July. Job gains in construction and other goods-producing areas were minimal. These numbers confirm that Canada's post-pandemic recovery momentum has faded, and that domestic demand is weakening even before new trade frictions take effect. The Canadian dollar has mirrored the economic slowdown. In early October 2025, the loonie traded around 1.39 per US dollar, its weakest level since May. Through September, it fell roughly 0.7% against the US dollar. A combination of softer oil prices, expectations of rate cuts from the Bank of Canada, and uncertainty over trade policy have contributed to the decline. A weaker dollar helps exporters slightly, but it raises import costs and adds pressure on consumer prices. That's a difficult balance when inflation is already close to the Bank of Canada's upper tolerance band. Canada's trade exposure extends beyond the U.S. relationship. Relations with China remain tense, and supply chain disruptions continue to weigh on manufacturing and logistics. Reuters described this as a two-front trade war, a situation where Canada must manage multiple external risks while having limited domestic policy tools. Operational disruptions have also underscored Canada's infrastructure vulnerabilities. A recent CBSA system outage caused delays and trucking backlogs, temporarily halting billions in cross-border trade. Events like these highlight how fragile the trading system is when technical or political shocks occur simultaneously. Heading into the Washington talks, Canada faces three primary risks. Tariff escalation, if the U.S. expands duties on metals or manufactured goods. Currency instability, if market confidence weakens further. Domestic slowdown, if declining services activity and job losses spread into goods-producing industries. Best-case scenario, Carney secures temporary tariff relief and maintains predictable USMCA conditions. Worst case, renewed tariff disputes erode confidence, the loonie weakens further, and inflationary pressures rise into 2026. The outcome of this meeting will determine whether Canada can stabilize its trade position, or whether policy drift and weak growth become the defining story of its economy heading into next year. The October 7th meeting will not be symbolic. It will be an early test of how Canada manages limited leverage in a shifting global trade landscape. For businesses and households, the results may quietly shape employment, prices, and the value of the dollar in the months ahead.